and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Despite uncertainties, India's equity market scaled new highs last year. It made investors richer by more than 16.36 lakh crore rupees. But how will the markets and the economy behave in 2023? Will they remain resilient amid familiar challenges? Puneet Madhva tells you what leading economists and market analysts think.
After a modest return in calendar year 2022, analysts see 2023 to be a tale of two halves for the Indian markets and economy. COVID fears amid China's reopening, macroeconomic data and economic growth, policies of the global central banks, geopolitical situation, the union budget and the market valuation back home are likely to shape the first 6 months. The second half of 2023, according to experts, could see the impact of the policies implemented by regulators to bring inflation and recession fears under check, which in turn could propel markets higher.
I don't expect 2023 to be a blockbuster year, especially in view of the major headwinds like COVID fears as well as the hawkish stand taken by Fed, which again will have a trickle-down effect on the other central banks. Secondly, the fear of a slowdown transforming into a recession in Europe and US could actually keep the markets on the edge. However, the second half of the year should be better, as India should outperform, especially with China +1 and now Europe +1, which may actually play out well. And when you outperform, the FIs really can't afford to ignore the market. So liquidity will flow into those economies which have been performing, and clearly India would prominently be among them.
UR Bhatt of Alphanity Fintech, on the other hand, believes that markets are factoring in a number of positives that are likely to accrue even at the current levels.
I think that's entirely possible, but the fact of the matter is that market has already factored in quite a lot of these things already in the price. Like, say, for example, the market certainly believes that the US interest rate hike sort of season will be over sometime in the late first quarter of 2023 or early second quarter of 2023. So sometime during that time. So and the peak rate could be probably somewhere between 4.85 to 5%. So this is what the market has factored. And as a matter of fact, if you really see, inflation has started sort of coming down a bit. So therefore, there may not be that much of a need for fresh hikes beyond what is already expected. So as long as there is no negative surprise in terms of hikes, as long as inflation, there is not much of a negative surprise there also. I think the market has factored all this in. Now we have to really see, once we reach the interest rate peak, then we have to see how much time will the Fed take to start talking of cutting interest rates. That would be probably best part of 2-3 quarters. But once there is some indication that they have picked it out, interest rate has picked out, then I think people start betting on interest rate cuts. So therefore, that probably would be in the second half, and that is when I think people take a call on that and start reacting in the markets. So I think market could be, you were saying that the first half could be bad because of macroeconomic. I don't think it's getting any worse. It's only probably going to get better. Because if you really see, it is all this winter and all that, even the Ukraine war is sort of ebbing away. Because not all sectors will be reacting the same way. But as far as India is concerned, I think it is the domestic-facing industries which will probably do well. Because India, the growth is probably exports may not be very strong because of the international situation. But I think domestically, consumption-led sort of sectors should do well.
While most brokerages remain bullish on the road ahead for equities, they suggest investors remain selective, be in the right sectors and stocks to earn a good return on their equity portfolio. Those at Credit Suisse, for instance, suggest investors focus on sectors regions with resilient earnings and companies that can defend margins. Among sectors, banks, auto, pharma, select consumers, healthcare needs more attention according to BNP Paribas. Jefferies, on the other hand, expects Nifty to remain range-bound between 17,500 and 19,500 levels due to steep valuation. However, they prefer a buy-on-dip strategy. Morgan Stanley and Julius Baer, however, have more aggressive Sensex targets. Morgan Stanley sees the index hitting 80,000 levels and Julius Baer expects 70,000 levels by December 2023 in their best case scenario. As regards the Indian economy, Aditi Nair of ICRA expects the growth rate as measured by the GDP to moderate in the year ahead.
What we're broadly bracing ourselves for is that growth is going to be slower in the coming year, both in terms of the real GDP growth as well as the nominal GDP growth. And hopefully, inflation is going to be a lot lower as well. Perhaps a bit of a moderation on the CPI side, a lot more moderation on the WPI side. What matters to consumers is ultimately the CPI. So perhaps there we should be at least hopefully able to get some kind of relief, although commodity prices need to remain supportive, and the agricultural outlook as of now is looking pretty good, which we're very hopeful of. The Rabi sowing has taken off in a brisk manner, and the reservoir levels are also quite healthy when compared with seasonal trends. FY24, we're looking at GDP growth coming in around 6%, down from 7% or thereabout in the current year. And on the CPI inflation side, we're expecting the headline to moderate to about 5.2% or so for the next fiscal, from 6.6% for the current fiscal. On the twin deficits front, perhaps we're hopeful that at least there will be some fiscal consolidation going ahead. We would like to see a number which is around 5.8% of GDP for Government of India's fiscal deficit for FY24. And on the current account deficit, here certainly the outlook is a lot gloomier and less certain. We do think that domestic demand is going to remain relatively resilient going into 2023. This is barring any COVID shocks or any other black swan events. But certainly, the external side is not looking that great.
Markets in the first trading week of 2023 are likely to remain range-bound in the absence of any major cues. Stock-specific action is likely to continue as the markets await global triggers and the December quarter corporate results season back home that begins next week.
It looks like a familiar territory, but with somewhat greener pastures. Is it a mirage, or will this year turn out to be better for us? What will be the key developments that need to be tracked in 2023? Bhaswar Kumar tells us in this report.
The fireworks have faded and the celebrations to mark the new year have given way to the usual humdrum, and 2023 has started on a mixed note. While our current account deficit has widened to a 9-year high, experts say that it will come down in the next quarter. There is a broad consensus that the year will see a global recession, but the world has also received a respite from record high inflation. Despite last year's shocks, India has emerged as the fastest growing major economy. COVID-19 is surging again in China, but we are better equipped this time. Against this backdrop, there are 5 key events and themes that will be worth tracking in 2023. Finance Minister Nirmala Sitharaman will present the Union Budget for 2023-24 in Parliament on the 1st of February. It will be the last full budget of the Modi government in its second term. On a worrisome note, the fiscal deficit remains far too high. It is close to the pre-COVID peak of 6.5%. Earmarking larger budgets for defense, education and healthcare while bringing it down will be the major challenge. Meanwhile, an agency report cited sources saying that the government was likely to increase the income tax exemption limit to 5 lakh rupees from the existing 2.5 lakh rupees in the forthcoming budget. Such a move could leave more disposable income in your hands. This good news aside, sustained recession in the West and apprehensions of a new COVID wave have cast a shadow on Budget 2023. This brings us to the next topic, renewed COVID-19 fears. China is seeing an alarming rise in infections and it has pivoted away from its zero COVID policy. The country has also scrapped quarantine for inbound travelers from 8th January onwards. As a result, Chinese citizens are rushing to book international flights, leading to apprehensions of a spread occurring again. If that happens, global supply chains may be disrupted further and growth across countries affected. The recent surge in COVID cases in South Korea, Japan, the US, and France has also raised concerns. Closer home, people arriving in India from China, Hong Kong, Japan, South Korea, Singapore, and Thailand will have to show a negative COVID-19 test from the 1st of January. States are checking the availability of oxygen cylinders, ambulances, ventilators, and items needed in medical emergencies. Government hospitals also recently conducted a mock drill to assess their preparedness. Indian citizens who had mostly moved on from COVID may find themselves anxious once again. The other issue, if one can call it that, which will be keenly tracked in 2023, will be the continuing Ukraine war. Russia's invasion of Ukraine in February of 2022 led to soaring commodity prices and elevated inflation. While the centre's subsidy outlay ballooned, the Reserve Bank of India's inflation fight became more complicated. In the midst of the projected recession in the West, including India's biggest trading partners in North America and Europe, and continuing volatility in commodity markets, any signs of the conflict abating in 2023 will be welcomed. However, at the moment, there isn't any good news on this front. Speaking of RBI's challenges, the year 2022 saw the central bank start acting on the policy repo rate after a gap of 2 years. In an out-of-turn meeting, the RBI's rate-setting panel decided to increase the repo rate in May last year. The trigger was the Russia-Ukraine war. CPI inflation stayed above the central bank's upper tolerance band for the first 10 months of 2022. During the previous year, the repo rate was increased sharply by 225 basis points to 6.25%. The recent commentary by RBI Governor Shaktikanta Das and Deputy Governor Michael Patra suggests that they would again vote for a hike when the Monetary Policy Committee meets in February. However, two external members, Jayant Verma and Ashima Goyal, have argued for a pause. The outcome of the February meeting is still undecided. However, experts believe that the RBI will be heading for a long pause before rates can be lowered again. Meanwhile, analysts reportedly expect the global interest rate cycle to peak out in 2023, with the focus shifting to the extent of economic slowdown. Developments on these fronts will guide Indian markets in 2023. Last but not least, 2023 will also see a lot of movement in domestic politics. It will be a year when 9 states and perhaps the Union Territory of Jammu and Kashmir will go for assembly polls. The results of these state polls could set the tone for the upcoming political battle, which will be fought in 2024 when general elections will be held. Depending upon how the results pan out, the opposition may find itself rejuvenated. The results will also reveal which political leaders have the most bargaining power if the opposition attempts to unite for the Lok Sabha polls. The states that will go to the polls are Tripura, Meghalaya, Nagaland, Karnataka, Chhattisgarh, Madhya Pradesh, Mizoram, Rajasthan, and Telangana. Clearly, 2023 will be a crucial year. Against this backdrop, Business Standard's senior editor, Suveen Sinha, who will be tracking these developments through the year, gave his insights.
In Jab We Met, one of the movies many of us would have enjoyed, there is a moment when Kareena Kapoor is totally exhausted by the events of the tumultuous night. Having run out of a cheap motel, she is sitting in an empty bus and praying, "Bas Baba ji, boring bana do ab is raat ko." She is desperate to have an uneventful rest of the night. After 2 tumultuous years, that is the feeling we have now. We need a boring year, one without pandemics and wars and layoffs and threats of economic recession. The regular ups and downs will do, thank you very much. The regular ups and downs will include the budget, which is a big highlight every year. Secondly, we expect central bankers around the world to take a breather in rate hikes. and we hope to have a solution to the war in Europe. However, we are also entering a turbocharged election season. Several states go to polls in 2023 before 2024 ushers in the big one, parliament polls. Now, a central government completing 2 consecutive terms may be watching out for many things. It is a crucial juncture. No Prime Minister has served 3 consecutive terms since Pandit Nehru. No party has since the Congress at the beginning of independent India. How will that knowledge affect policy and governance? We hope it will be nothing too exciting. Wish you a boring year ahead.
While all budgets are important, there is a lot riding on the forthcoming one. India Inc. hopes that it will increase broad-based consumption. According to CMIE, India's unemployment rate in December 2022 was at its highest level since the pandemic. People will look to the budget for a remedy. On the COVID front, one prominent expert has said that there is little chance of a significant outbreak in India in the next 2 months. Others have pointed to the hybrid immunity acquired by Indians as an advantage. This may temper some of the anxiety that re-emerged recently. Overall, cautious optimism seems to be the right approach towards 2023.
The government's ambitious asset monetization plan was on track last year as it surpassed its target in the fiscal year 2021-22. It reportedly collected 1 trillion rupees against the target of 88,000 crore rupees. But what is the current situation like? Is the plan on track to meet the target in the current fiscal too? Continue watching to know more.
In August 2021, Union Finance Minister Nirmala Sitharaman announced the National Monetisation Pipeline, or NMP, aimed at generating 6 trillion rupees over 4 years ending 2025. In this pipeline, the government has planned to lease out assets across sectors such as roads, railways, power transmission, and telecom to private investors. Roads, railways, power transmission, oil and gas, and telecom are the top 5 most valued monetization sectors. They account for almost 83% of the 6 trillion rupees aim.
It's the first time ever that the government is trying to monetize its assets which are not being used most efficiently. So I think it will unlock a lot of capital, which can then be put to much better and much more effective and efficient use. So I think it's the National Monetisation Program is a breakthrough in government policy, and the target that they've set is very reasonable.
Various reports citing unnamed sources said the government surpassed its monetization target of 88,000 crore rupees and raised 1 trillion rupees in the fiscal year 2021-22. However, in the current fiscal year, it was reported that the government has only monetized assets worth 33,000 crore rupees, of which Coal Ministry raised 17,000 crore, which is more than 50% of total monetization. This year's monetization realization target is 1.6 trillion rupees. The first phase of asset monetization was led by the Roads and Transport Ministry and Coal Ministry. In 2021-22, roads and highways worth 23,000 crore rupees were monetized. For FY23, the National Highway Authority of India has set a target of 30,000 crore rupees worth of monetization. Over the 4 years, the monetization target for roads asset is 1.62 trillion rupees. This sector alone makes up 27% of the 6 trillion rupees aim. A Finance Daily recently reported that the government is mulling budget aid to NMP to boost monetization in the coming budget session of the parliament. This aid will be in the form of support to infrastructure ministries such as railways and roads on the basis of their monetization performance. The aid is being thought of at a time when the government is looking at falling behind the monetization target of FY23.
Well, there's a lot of things going on. The government has had a lot on its plate because of the post-COVID situation. That plus, I think the stock market and generally the capital markets were quite uncertain. And the global uncertainties also made sure that we couldn't depend upon foreign direct investment. And I'm hoping that in the fourth quarter, our government will make up a significant amount of that.
In the current fiscal year 2023, the monetization target for railways was set at 57,222 crore rupees. It was later revised down to 30,000 crore rupees due to the ministry's subpar performance in monetization. Business Standard reported last month that railways had only achieved 6% of its 30,000 crore target in FY23. Even in the best case scenario during the last 2023 quarter, it will miss its target by almost 85%. The monetization target for railways in subsequent fiscal years is 44,907 crore rupees for FY24 and 32.5 thousand crore rupees for FY25. The Ministry of Railways was reported to have dropped the idea of monetization through public-private partnership. It is now pursuing monetization through engineering, procurement and construction mode or EPC mode. In the current fiscal year, Railways is hoping to achieve almost 5,000 crore worth monetization. The Department of Telecommunications or DOT under the Ministry of Communications has also failed to achieve its monetization target. As of December 2022, DOT had not raised any money against its target realization of 20,000 crore rupees. The telecom sector under National Monetisation Pipeline has a target monetization of 35,100 crore rupees over 4 years. The 20,000 crore rupees target included monetization of over 5 lakh kilometer of optical fiber laid by BharatNet, which is the world's largest rural connectivity project led by the Indian government. The monetization target also included mobile towers. However, the DOT has now dropped BharatNet from the monetization plan. It will now explore alternative assets to achieve monetization targets.
Key hurdle to a program like this is that the incumbent organization, needs to be on board with the plan. And that is very difficult because it is like somebody having to say that I can't do my job well and therefore somebody else needs to do it. Right? In roads, it has happened because of a history of, the way NHAI as an organization has fought. Right? But in railways, very clearly, the incumbent organization itself doesn't seem to be. And that is not an easy problem to solve because many of these sectors are technically, kind of sensitive. There are a whole lot of technical, commercial, and regulatory issues that need to be solved, in which the incumbent has to play an active role.
A lot of the asset monetization has been planned through public sector units or PSUs. Warehouses, stadiums, lands, pipelines, and various other assets that are owned and operated by PSUs are up for monetization. In case of oil and petroleum PSUs such as IOCL and ONGC, the monetization was planned via infrastructure investment trusts. However, that plan was shelved. Both the government and PSUs are now exploring other ways to achieve monetization.
The program has got labeled as a fund or a finance raising program. If you've got a good asset and which is earning cash flows, you can get money through debt, you can get money through equity. The value add is when you get expensive equity capital, you also get expertise and efficiency improvements along with it, which is really at the core of PPP.
With an ambitious target of 6 lakh crore worth of monetization, the government has only 2 fiscal years to go. So far, it has monetized about 1.2 lakh crore worth of assets. With almost 5 lakh crore more to raise, how should it proceed and what is the way forward?
The way the government could handle all of it is that they can get the line ministries to hand over their assets to a centralized department or a central ministry, like for example, the Department of Public Enterprises, so that all of them get collected in one place and any interest that the line ministries may have to continue to retain these assets can also be overcome in that manner. Some of these assets are quite valuable and I think they will find takers. in the private sector, both nationally and internationally.
With the monetization deadline nearing, the government will have to ramp up the process. Uncertainties may continue well into 2023, but they can be mitigated by efficient processes and taking the interests of all stakeholders into consideration. Apart from raising 6 trillion rupees, the target should also be to improve efficiency of assets.
The much awaited decadal census didn't kick off last year due to the pandemic, and it is unlikely to happen this year too, as at least 9 states will see elections. But what is a census? Why do we need it? We decoded it in our next segment.
The word census has its origin in Latin. Romans used to maintain the list of all adult males for combat roles. They used to conduct this exercise every 5 years. Somewhat similar exercises used to be conducted in ancient China, Egypt, Persia, Palestine, etc. In the modern world, most countries conduct population census every 10 years. Some even do it at an interval of 5 years. The United Nations recommends that population census be conducted at least every 10 years. Census is a process of collecting, compiling, and analyzing demographic, social, cultural, and economic data which helps governments roll out policies. Like in India, the Finance Commission gives grants to the states on the basis of the census data. It is also a report card of the government policies and tells if the benefit of the economic growth has reached the people or not. The first full census in India was conducted in 1872. Since then, there have been 16 such exercises till the last one in 2011. The next census, which was supposed to take place in 2021, got delayed due to the pandemic, and this is the first such delay in the history of the Indian census. According to estimates, India's population may have breached the 140 crore mark, and we are about to take over China as the world's most populous nation on earth in a few months from now. Collecting data of such a huge population needs massive resources. Millions of enumerators go home to collect information about people. The Office of the Registrar General and Census Commissioner, or ORGI, is the office that is responsible for conducting censuses in India. Census is done in 2 phases. The first phase is called house listing, and mapping of houses and preparing the lists of assets possessed by each house is done in this phase. In the second phase, data is collected from various demographic, socio-cultural, and economic parameters, along with migration and fertility characteristics of individuals. Experts have raised concerns over the delay. Government schemes are still being planned and executed according to the 2011 census data. It may deprive a large population of government schemes. The delay in conducting the census has also attracted criticism of the government. The census will help decide the delimitation of Lok Sabha seats and the devolution of funds to the states. Some states, especially those in the south, argue that the use of 2011 census data to decide the devolution of funds to states was unfair to them. According to Business Standard editorial, the census is the basic building block of many instruments of state policy that are essential for proper provision of goods, the effectiveness of governance, and even ensuring a fair and just division of expenditure across regions and target groups. The census might be delayed, but this delay has only underlined its importance in policymaking and functioning of the Indian democracy.
The nation's trusted bank, SBI, the banker to every Indian.
A Business Standard report said that census is unlikely to be held before the 2024 general elections. That is all for today. For more news, views and insights, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.